I believe then we can get started with today's session when we will talk about volume, price analysis in Forex, and we'll combine that with Confluence trading. We want to deal with chapter 12 and chapter 13 today. Great. There is something that a number of Forex traders don't look at, and that is volume. Many times they will tell you that volume may not be important in trading because they say volume in Forex is not true. This is not true volume. But I come to realize that this volume is about 90% true in what it says. About 90% of the time, always true in what it says. So when you think of volume price analysis, there are a few things I would like you to put to mind. This is volume price analysis. This is supposed to be a complete course. But because I've just added part of it to our price action course, for now I'll give you a few tips on how to use volume price analysis in Forex. In the case you're interested in a full volume price analysis or volume spread analysis, VSA. Sometimes you might call it VSA, volume spread analysis. If you want to learn everything about volume spread analysis, you can take a separate course for this. This usually has a different track because there's a lot to learn from. From my experience in the market, I've known two things. Price action is powerful. This is what you have been learning. This is what you've been learning. Price action is powerful. All of these things you've been covering are price action.
Okay.
Volume analysis is powerful. But now when you combine these two, literally you cannot be stopped. You become unstoppable in the market. And that's a reality. The moment you master both, volume price analysis together with price action, when you understand everything here and everything here, you start seeing the market better than everybody else can see it. For many reasons, price action is good, but price action is subjective. Price action is good, yes. It is better than just trading with indicators. But at least one problem with it is price action is subjective. Why do I say it is subjective? Let me show you. If I gave this chart to people and asked them to draw support and resistance, I'll get different results. This same chart, I will get different results. Why? Somebody will say that is resistance. Another person will say, no, resistance is here. Okay? Someone else will even put this on as support. But someone will understand this is resistance, so that could be a range. So they leave that. Another person will say this is a nice resistance because it just acted as support before. Another person will come and put a level here. But another person will say that will be too close. The next level is probably here. And another one will say, no, I think this is resistance, so this has to be a resistance. The other person will put this level. Another one will put this level. There's somebody who can put all of these levels I'm highlighting, like this. And another person will say, no, I think this is a better level. And I don't think we need both. Maybe someone will remove this. And someone will say these are the levels. So you see why that becomes subjective? People will see different things on the chart, depending on their skill and experience. That is one aspect of a subjective technique of trading, okay? So considering when you're trading here, one person will take this signal as bearish. Someone will say, no, this is a very big candle. This is not a bearish engulfing. Someone will come and take this trade here and say this bearish engulfing. And someone will say, okay, the candle did not close below the wicks, so it's not good. Another one will take this one. So there is a lot of subjectivity with price action. How we draw trend lines, for example. One will try to draw here. One will just use this and this. Another person would have seen this one and connected these two and is waiting for a setup. Yet another person would have connected this and this and said, I'm waiting for a setup. So you see, same chart, people draw different things, people see different things. So it at some point in time, it will depend on your skills and your experience to use price action. Now, interestingly, volume analysis is completely objective. Volume analysis is purely objective. Volume is the same for everybody. Add your volume from insert, indicators, volume, and volumes. I like making this bars bigger like this. Not the small one, but around 4. What you see down here is what everybody will see. It will not depend on who you are. It is the same thing. Now, volume, unlike price action, volume will be able to tell you when someone is playing around in the market, when someone is cheating. You've heard of people manipulating the markets. Fake outs where you see a breakout and then the market doesn't respect the breakout, it comes back in the range. And that is manipulation. You want to know whether a movement in the market is genuine or a fake. Price action will not tell you it's genuine. It will not. But volume will tell you that movement is genuine. Price action will not spot a fake movement. Volume will tell you that's a fake movement. And that's why the moment you have mastered complete volume spread analysis or volume price analysis, if you combine it with what you have been learning, support and resistance trends, you will see the market like a sniper. All right, so 3 things I want us to learn from a volume, because we can't cover. Volume has about 16 signals you can take, but you cannot cover all of those. So I want to look at volume and the trend. How can I use volume to justify my trend? An uptrend or a downtrend? And remember, when we talk about trend, we talk about the impulsive wave and the corrective wave. You remember that? The longer waves in the direction of the trend and the smaller waves going opposite the trend. If you remember, in an uptrend, we were drawing things. Impulsive wave, corrective wave. Impulsive wave, corrective wave. Impulsive wave. So how can I use volume to understand those two? So number 1, volume for trend analysis. Number 2, I want to use volume to determine a breakout, whether it is genuine or fake. And number 3, I want to use volume to support my candlestick signals. So those are the 3 things I would like us to talk about. And this cannot be a complete course, it's just a fraction of it. Now, number 1, you need to understand one thing. Volume is like energy. Volume is like fuel. Think of volume as fuel. Okay? For your car to move up, or let's say for your car to move forward. For your car to move forward, you need what? Fuel. For your car to move backward, to reverse, you need fuel. In other words, what we are saying is whether the market is moving up or a market is moving down, it needs energy. It needs some power. Market needs power to create an uptrend. Market needs power to create a downtrend. So volume is like our fuel. If we have enough fuel, we will continue moving up. If we have enough fuel, we'll continue moving down. If the fuel has decreased so much and we were still struggling to move up, we'll find ourselves reversing. And you know, if you are going uphill and there's no fuel in your fuel tank, the car will start reversing. Or we stop and start reversing. Okay? So think of it in that perspective, because volume volume is not directional. That's one thing you must understand from the beginning. Volume has no direction. I will show you. For example, this is a short uptrend. This section here, volume was increasing. Now, let me give you a downtrend. This is a short downtrend. Volume was still increasing. So, what are we saying in short? For an uptrend, volume must increase. For a downtrend, volume must increase. Volume increases in an uptrend, volume decreases, increases still in a downtrend. So it's not like one is up, one is down. No. Like I said, the volume is fuel. You need fuel to continue going up or to continue going down. I'll give you another example so that you don't have that problem of distinguishing between the two. This is a long uptrend, you can see from here. This is a long uptrend. And if you look at this long uptrend, there's one thing that you'll notice. Let's say all the way up to that level. If you look at it, volume was actually generally was also increasing. Look at this bar here. Look at this bar here. Look at this bar here. Look at these bars down here. Volume has been rising as the trend was also rising. Now let's get a clear downtrend, and then you tell me what you see. This is a downtrend. Let me get a better downtrend, a long one. A long downtrend, maybe like here. Let me see if I can spot one that's a clear, yeah, like this. You may also have spotted that from here to here, you may not realize it, but volume was also increasing. Volume was increasing many times. For example, here, volume increased up to that point, then increased up to that point, then increased up to that point, then increased up to that point. So added together, volume was just increasing, taking a break and then increasing, taking a break and then increasing. So you need volume to increase in an uptrend, you need volume to decrease in, to increase in a downtrend. Now, what does it say? If this is now what you need to understand, and this is how you start using volume also. If you have an uptrend, and in that uptrend, you notice that volume is decreasing. If you have an uptrend where volume is decreasing, sorry, mtoto ameamuka ameanza kuleta issues. Just a moment. Toto. Billy. Unyauje? So volume will keep moving, increasing in an uptrend. Volume will keep increasing in a downtrend. So I can use my volume to determine if a trend is going to stop or a trend is going to continue. Let's return our moving averages, for example, the 50 EMA, green, and the 100 EMA, red. Now, we have been using this visually to tell us whether a trend is up or a trend is down. Now, let's say from here, let me show you something interesting with volume. From here, from this point, you know, manual sitting room. From this point, you can see the intersection of the moving averages.
Yeah.
Up to where again they intersected. one thing you will notice is this is an uptrend, and generally, if you look at the bars from the intersection point, the bars are rising. Oh, sorry, can't draw it quite well, but you can see the bars of the volume are going up. They appear like they are decreasing, but they keep, generally, you look at that bar there, is higher than this. So as the market is making higher highs, higher lows, the bars on the volume are doing the same thing. That justifies an uptrend. Now, in a downtrend, you will see some similar behavior. You will see some similar behavior. This is not a good downtrend because of it's not making lower lows. Let's see one where we are making clearly lower lows and lower highs. Now here, where do we have a downtrend? Okay, I want to pick one here, for example, from the intersection here, from the intersection where the moving average is crossed, I think around here. That's where the lines crossed. The volume was around here. Now let's consider that as we move down. Now we are here. Where is the volume? Here. We were here. Now the volume was here. So generally, you can see the volume is also increasing in a downtrend. So that is logic number one that you need to understand when you're handling volume. It increases in an uptrend. It increases in a downtrend. Now, we have been saying this is the structure of an uptrend. We have been saying in an uptrend, you have a low, a high, a low, a higher low, a higher high, a higher low, a higher high, a higher low, a higher high. Now, volume increases here, volume increases here, volume increases here, volume increases here. However, when the market is doing this movement, volume should decrease. Volume should decrease. So in an impulsive wave, volume increases. In a corrective wave or a pullback wave, in a corrective wave, volume is supposed to decrease. Let me show you that. Now, let me see a structure where we can just get those levels clearly. All right, like here. So markets, you can see the market doing this. Market goes up, comes down, goes up, comes down. Slightly like this. Okay, assuming I've drawn them correctly. Now look at below. Volume was also increasing when this one was moving up. When this one was coming down, what happened to volume? It was also going down. Okay, then when the market was making that up move, impulsive wave, volume increased. Corrective wave, volume decreased. Impulsive wave, volume increased. Corrective wave, volume decreased. Impulsive wave, volume increased. Corrective wave, volume decreased. Impulsive is here, volume went up. Correction, volume went down. You see that? Same thing would happen in a downtrend, even here. You will be able to tell whether a downtrend is genuine or is going to end if you see those patterns change. For example, therefore it means if you see volume increasing in a corrective wave, remember, in a corrective wave, volume is supposed to decrease. If you see volume increasing in a corrective wave, that could be a reversal. The market could be changing direction now, officially. Because this is what we are saying. If you expect the market to be going up like this, every time it goes up like this, volume increases. Volume increases. Volume increases. But when it makes this shorter movement against the trend, volume decreases. It means as long as it obeys this structure, the uptrend will continue. So when will the uptrend stop? When will this uptrend stop? On two occasions. One, if the market is making an impulsive wave, but the volume is decreasing instead of increasing. Or the market is making a corrective wave, but volume is increasing. All right?
Mm-hmm.
We'll be able to spot some cases. Let's see. For example, let me show you something. That's how you know that the market is going to reverse. We understand that we have a downtrend from here.
Yeah.
So market moves down. This is supposed to be an impulsive wave.
Mm-hmm.
An impulsive wave is a move in the direction of the trend. So market is moving, but what do we see in the volume? Somehow also going up. Market reverses to the upside, but now that reversal is also on high volume. All right, volume was increasing in the impulsive wave. Volume was also increasing in the corrective wave. That's a signal there's a problem with this downtrend. Then we wait further, volume goes down. This is now an impulsive wave, but volume is decreasing.
Yeah.
That is a wrong signal because for market to move down, it requires volume. But here volume is not supporting it. You see, with the price action, this is a lower low, which is a clear indication of a downtrend. Lower low, lower high. Lower low, lower high. That's a downtrend. But volume is saying, yes, it may be a downtrend, but there's no energy in that downtrend. Because for the market to continue moving down, volume should be increasing, not decreasing. Here, volume is decreasing clearly. And the opposite is happening. When a market is going against the trend, volume is supposed to be decreasing. But what do we see? Volume is increasing. There's complete anomaly. There's something completely wrong with this trend. Yes, we see another wave down. Volume is supposed to increase, but volume is decreasing. And when market is going against the trend, volume is increasing, completely abnormal. But you also spot one thing here now, a double bottom. A double bottom is a clear indication the market will reverse. You wait, this is a W shape. You wait for the market to break the high, you buy. Because clearly, this is not a downtrend. Okay? So let me type something for you, maybe to help you out in as you write your notes. So when you say uptrend, volume, an uptrend volume increases, in the impulsive wave, up, and it decreases in the corrective wave, the wave that is going down. In a downtrend, volume increases in the impulsive wave, which is down, and it decreases in the corrective wave. Corrective wave is up. Corrective wave is up. The above order or law is disrespected. Expect a reversal or range to form. So if you don't see that order, the order I've outlined above there, expect the market to go into a ranging market where it's moving up and down in the same range. You understand ranges now, or to simply change the direction. If it was a downtrend, you expect to reverse to an uptrend. If it was an uptrend, expect a downtrend to start. So those laws must be respected. If market must continue going further up, volume must increase when the market's moving up. If the market must continue going down, that means a downtrend must continue. Then when candles are moving down, volume must increase. If you see the opposite, that trend is not going to last. Okay?
Yeah.
All right. So let's keep that in mind. So I said I wanted to talk about volume and trend. Now you know that volume increases in an uptrend, it increases in a downtrend. When we are making a corrective wave, a pullback, volume must decrease. If volume is not decreasing in a corrective wave, then it is signaling the end of that trend. Like here, clearly, this is a downtrend. When the market is making that corrective wave, we expect volume to be decreasing. But here, volume is not decreasing. This is a clear indication this downtrend is not going to stay there for long. All right, so let's look at volume and the breakouts. Volume and breakouts. How can I use volume to say whether to see whether a breakout is going to be genuine or a fake? Now, you probably read books that say breakouts fail about 70% of the time. About 70% of the time, breakouts fail. Breakouts fail. Now, what's a breakout? If you have a resistance and the candle breaks and closes above resistance, that is bullish breakout. If you have a support and a red candle breaks through support and closes below it, that's a bearish breakout. So that's a breakout. A breakout happens when a price breaks a level in the chart. That could be at a support resistance level. It could be a trend line. It could be head and shoulders, neckline, any of those levels on the chart. When broken, we say it's a breakout. Okay? It could also be breakout of a moving average. Remember, moving average is dynamic support and resistance. It could be a breakout of Bollinger Bands. Last time we were looking at breakout of Bollinger Bands, okay, with the squeeze and spike. So whenever those things are happening, you can use volume to determine whether it is a genuine breakout or a fake breakout. Let's see some examples. If, for instance, I know this is a support and resistance. This is my support, my resistance, I would say, this level. Okay? I want to see whether there is a breakout or no breakout. I understand that could be a zone. It could be a zone from these candles to this candle. That's a complete zone. So I want to see whether there's a clear breakout or a fake breakout. Now, of what? I want to see the market breaking a level, and I want to determine if that breakout is genuine. You see this candle here? Okay, let's start from here. This is resistance, resistance, resistance. This is not a breakout. The breakout candle must close, the body must close above the level or below the level. The body of the candle, not the wicks. So this is not a breakout, but this could be a breakout. This candle, because the body managed to close above the level. This would also be a breakout, but this is not, this is not, this is not. This is a breakout. So how do I determine if a breakout is genuine or not genuine? Now, volume must increase before the breakout occurs. Volume must increase. I said volume is energy. To break a level, you need more energy. So you see the market building up energy before breaking a level. It must gather momentum to break a level. But if you see the market trying to break a level before that level is broken, you don't see any energy. You don't see any volume increasing. That's a fake breakout. Now look at this. That's a breakout. The candle that broke out in MetaTrader 4, green means volume has increased. Red means volume has decreased. That's the meaning of those colors. The green means this candle, the candle on this bar, required more volume. People traded more volume on this bar than this one. People traded more volumes, like more transactions were done here than here. More transactions were done here than here. But this red means fewer transactions were done on this bar. Remember, this is an hourly chart. For this 1 hour, the number of transactions was smaller than the number of transactions of the previous bar, which is green. So you look at the colors, you also look at the height of the bars. If this is the longest bar, this is the highest volume on the whole of this chart. Maybe this one compared to the one that you cannot see clearly. And this could be the smallest volume here. The bar is not even visible as such. So this is a breakout. Volume decreased when the breakout was happening. That's a wrong signal. What I expect to see is a green bar when market is breaking a level. And not just that, the previous bars must be green also. Previous. So we have a breakout, but the previous bars were not green.
They are not green.
That tells you that breakout is possibly questionable. That breakout is questionable. It's not a true breakout. Now let me show you. Look at this breakout here. Or better this. Because I believe by the time this one was trying to break, we still have some more weeks here. I like a breakout of both. That is wrong. I can't. Oh, that's a level I drew from the other tools. Okay, let me draw the same level. I'm including these weeks. This is the candle that broke out of the whole range. And if I'm going to use that one as a breakout, you can see that volume increased on the breakout candle. Volume had increased from the previous two candles. Low volume, increased volume, increased volume. That can justify the breakout that happened here. So volume can help you determine true and fake breakouts. Let me give you another example. You see a support here, a resistance here, body to wick, for example here. Now, what candle breaks above that zone? This is the candle. That is the candle. What is the color of the volume? Green. Volume increased before the breakout happened. Okay. Let's look at another breakout, maybe here. This is the bar that broke your resistance level. What is the volume bar? Green. Previous one? Green. That's a genuine breakout. In many cases, that will be the case. It will help you determine whether a breakout is genuine or simply a fake breakout. Now, that is volume with the breakout. If you were to introduce the other indicator we were using, last time, if you remember, we were using Bollinger Bands. You can also determine whether a breakout is genuine or fake. Bollinger Bands. Okay. Let's go to the 4-hour chart so that we have something different. When you see a candle break above the Bollinger Band, check the volume. If the volume was increasing, that breakout is going to be genuine and the market will most likely continue moving up. If you see a candle break a level and the volume is not increasing, that's a fake breakout. Let's see a clear breakout somewhere. This is a genuine breakout. Look at that. The candle clearly closed above the upper band. Remember, the upper band of Bollinger Band is resistance. But this is the first time it broke the level and the volume was increased here. The market went up. You will see cases where a candle will break above and the volume is not increasing, and you'll see what happens. Let me see if I can spot one. Well, it's simply the market cheating. The market simply cheating. Look at that. Candle is breaking above on red bar. Red bar means decreasing volume. Market changes direction. That's a fake breakout. Let me give you another example. Do we have another example of a breakout? This is a genuine breakout. We closed above, but the volume was increasing, so the market continues with the breakout. Here, volume increased also, so no problem. Market continues. Market for the first time broke below, but volume had been increasing, so market continues. Breaks, and volume has been increasing, market continues. Breaks above, market doesn't do anything much. That's a false signal. Volume is increasing, okay? Market eventually goes down, but of course it reverses for a while. So generally, you can use volume to determine if a breakout is going to last or is simply a fake breakout. Now let's talk about some of the signals you can take from volume. There are two important signals I would like you to master, and this will be part of our strategies. Last time, I gave you different candlesticks. I showed you, I taught you different candlesticks, or candlestick patterns. One of the candlestick patterns I showed you was something like this. Market is moving up. It prints a bar like this with a very long wick. All right? Color not important. This could be the same. Something like that. But the market was moving up. We said this is what? A shooting star. A shooting star. A shooting star is also called a bearish pin bar. A bearish pin bar. Or the market is moving down like this. You come across a candle that looks like this. Long wick to the bottom, small body, and a long wick to the bottom. This is a pin bar or a hammer, if you remember. Hammer or bullish pin bar. Why is it called a bullish pin bar? Because the market opened here, pushed all the way down, but was rejected. The buyers came in and pushed the market back up. So if you look at the territory of the buyers is stronger than the territory of the sellers. The sellers were able to conquer this short distance. The buyers were able to push the market a longer distance. So this signal is bullish. It says the market is likely to move up. Same thing here. Market opened here, okay? Tried to go down that distance, but were not able. Ended up closing up. So you see the gap of the buyers were only able to conquer this short distance. Okay. But the buyers generally, that's the sellers. The sellers tried to go all that distance, but the buyers pushed the market up and even were able to close above. So the whole of this candle is actually bullish, saying the market is likely to move up. The opposite is true here. Candle opens here, goes all the way up, but rejected at the top, pushed back down and closes here. So this is how much the buyers were able to handle this. The rest of the candle was done by sellers who rejected the prices. So that is a bearish signal. It says the market is likely to fall. So when you meet these candles, I would like you to look at them from a volume analysis perspective. These pin bars are also called upthrust and downthrust candles. Upthrust for the one pointing up, this one, whether red or green. Downthrust if it's pointing down, like this. Small body, long wick. Now, there's only one thing you need to check. When this candle prints on your chart, volume must be very high. For this candle and this candle, volume must be very high compared to previous candles. Now, that tells you the market for sure will reverse either immediately if there's a support and resistance, or later where there is a support and resistance. So it's not immediate always. If this candle forms immediately at support level, where you had a support level, the market will reverse immediately. If this candle formed where there was a resistance, the market will change direction immediately. But if it forms, if you see this candle forming here, and the next support is here, you wait until the market comes to your support, then you can reverse. All right? Now, let's look at these candlestick patterns on the chart, but now we are calling them upthrust and downthrust because of volume. That's the language we use in volume. So let's spot this. Remember, upthrust must be found in an uptrend, downthrust in a downtrend. So look at this candle here. Look at that candle where I'm putting my line. A very long up wick. Look at the volume down here, higher than the previous candles. Market reverses to the downside. That's a volume signal. Look at this. The market has been falling. Now, this is what I was telling you, you must wait for support. This is a pin bar. This. Can you see that? This is a pin bar. This one tells you the market is likely to go up because the volume, the candle here is higher than the previous. But you don't take a trade until you are at support. Where is support? Support is somewhere here. Support is somewhere here. If you take this one as your support, or you take the previous level as support, so you might have several levels from the previous drawings. So you wait for market to come to your support level, then you look for a signal here to buy. You don't take a trade just because you have seen that candle. This is a shooting star on high volume, this one. It says the market will go down. Why does it go down immediately? Because this bar formed right on resistance. Look at this. Was the volume high? Yes, compared to previous bars, market reverses. We are coming down. We have this candle. Is the volume high? Yes. Are we at support? Yes. These candles had already formed support. These previous candles had formed support resistance. So it forms right at support, and you can see the volume is high compared to previous candles, market goes up. So this is a down thrust candle. This is an up thrust. This is a down thrust. This is an up thrust. The up thrust worked immediately. Why? We are at resistance. So in short, what we are saying is, for an up thrust, you wait to see, assume you have a resistance here, you have a long tail, a tiny wick, and the volume down here is very high compared to previous candles. This is an up thrust. For a down thrust, you have a support level, you have a tiny body, a long wick towards support level. If you check volume, volume is higher than the previous candles. This is now down thrust, this is up thrust. Up thrust says the market will reverse to the down. Down thrust says market will reverse to the upside. All right? Are you following, or are you lost?
No, I'm following.
One last thing I want to mention before we move away from volume price analysis is you can also justify the candlestick patterns on your chart using volume. For example, a good engulfing, you know bullish engulfing. You know what a bullish engulfing looks like. Let me remind us. Bullish engulfing, you have a small red candle, and you have a bigger green candle that closes above the body, like this. When you have a bullish engulfing like this, and you want to use volume to filter your signal, you should always check that volume below is also bigger, like this. This supports your analysis, because a small candle must have a small volume. A larger candle must have a larger volume. That's how you can. This is how you can use volume to justify true engulfing candlestick patterns. Engulfing. Let's see some examples. Look at this engulfing here. Did the volume increase? Green is small, volume is small. Red is big, volume is big. This is a true engulfing. Let's see another example. Look at this one. Also increased, true. Look at this one. Is this a true engulfing? No. A red bar which is small has a higher volume than a green bar which is having a smaller volume. This is not a true engulfing, and you can skip the trade, or you look for other reasons. Now look at this engulfing also. The green bar is small, higher volume. The red bar is bigger, smaller volume. That is opposite. And you see it failed immediately. This pattern failed immediately. If you had used volume, you would not have traded this, because you know this is not a true engulfing. Now look at this. It's also telling you this is not a genuine engulfing. Look at this. This is telling you genuine engulfing. Small red, small volume. Big green, big volume. Same here. This one would have told you don't trade that setup. Maybe you have other reasons to trade it. This one is saying volume is increasing, volume is increasing. This is saying it's a genuine breakout. It's a genuine bullish engulfing. But of course, you wouldn't want to trade this because you are at resistance. You don't buy at resistance, you buy at support. At resistance, you are looking to sell. So you look for bearish engulfing, which is here. Small green, small volume, Bigger red, bigger volume. So this is the genuine signal, not the other one. So that's about volume. There are many things you would cover under volume. I told you there are about 20 signals from volume. And if we wanted to talk about volume, that would be a complete course lasting about 10 days also. So in case later on you are interested in using volume to do a lot of analysis and to trade volume only, maybe you can let me know. So I want us to talk about Confluence trading. This is the next thing that I wanted us to talk about today, Confluence trading. When you hear the concept Confluence, it should not scare you. Confluence should not scare you. Confluence simply means coming together. Confluence simply means coming together. And in trading, it means many different indicators giving you the same signal. Many different indicators giving you the same signal. For example, and I think I've shown you this before, but let's see it again. Let me get a place where we can get a good setup with those explanations. Can get a good level, maybe. Okay, let's see. This was previous resistance, broken, acting as support. And now you are familiar with this concept. Now, this is support. What candlestick pattern is this? Bullish engulfing. Okay? All right. Let me just add more things and I'll explain what I'm trying to achieve here. Then, if I pull out my Fibonacci, and push it from here, what do we get from this level to that high? My bullish engulfing is forming at level 61. Very important. Let me add my moving average 100. I add my moving average 50. Our bullish engulfing is forming at 50 EMA. Now something interesting is happening here. Let me show you what it is. Kuna mtoto leo ameamka na kisirani hapa. All right, look at what you have on the chart. Number one, I'm interested in this setup. Reason number one, why I would trade here. We have an uptrend. In an uptrend, we are buying. Correct? Number two, we have a support level. This was initially resistance. Now is support. So we have support. So that's reason number one, to buy. Reason number two, we are buying from support, which is what is supported. We are buying at Fibonacci 61. Fibonacci 61. We know that Fibonacci 61 is a retracement level. Reason number three, why I should buy. Reason number four, our pattern here, bullish engulfing. Our bullish engulfing tells you to buy for reasons. Reason number five, we have EMA 50. EMA 50 acting as dynamic support. Our pattern right formed on EMA 50, which is dynamic support and resistance. So, what is interesting in this case is we have 5 reasons to buy. Those are 5 confluences. 5 confluences. In an uptrend, we know we are supposed to buy. At support, we know we are supposed to buy. If the market went up and came back to Fibonacci 50 or 60, we know we are supposed to take a signal. If we have a bullish engulfing pattern, or a bullish pin bar, or a morning star, those are bullish signals. They say the market will go up. If the market was above 50 EMA and comes back to 50 EMA, we expect 50 EMA to act as dynamic support. All right. So you see, these are 5 different things telling you the same thing. They are simply saying you can buy, you can buy, you can buy. Understand?
Yeah.
That's what we call confluence trading. Why is confluence trading? Why is confluence trading important? You can see my chart still. Confluence trading is important because sometimes one signal is not enough. Sometimes 2 things could be wrong. But if many things are saying the same thing, you are probably right. Now, in my confluence trading, these are the things I teach. Bare minimum. Number 1, always follow the trend. No matter what trade setup you are taking, try to take the setup in the direction of the trend. Are we there? Number 2, make sure you only enter your trades at support and resistance. We use support in an uptrend. We use resistance in a downtrend. Number 3, your trade must be initiated by a candlestick signal. Candlestick signal. Candlestick patterns. The pin bars, bullish engulfing, morning star, evening star, inside bar, all of those. They are the ones that tell you now you can buy, you can sell. But you buy at support in an uptrend, you sell at resistance in a downtrend. So bare minimum, you need these 3 confluences for you to make an entry. Now, beyond these 3, you can add trend lines. If your signal forms on a trend line, it's another additional confluence. If your signal forms on a Fibonacci number, 50, 61, those 2 are very important. Sometimes 38 would work, but I like 61.8 and 50. That's a better signal. If your signal forms on Bollinger Bands, now remember the lower Bollinger Band line is support, the upper Bollinger Band is resistance. That's an additional confluence. If you can apply a volume to filter your signal, maybe you are taking a breakout or you are taking a trade. Now, what do we say about a market that goes like this? Volume is supposed to decrease here when the market is coming down because this is an uptrend. If you see the market is coming down and the volume is decreasing, that's a good signal because volume is supposed to decrease here. It's only supposed to increase here. So you can use volume again as a measure, as could be confluence. All right? Then you can use moving averages as dynamic support and resistance. I've shown you many times that price bounces from lines. Look at that, dynamic support. Look at that, dynamic support. This is 50 EMA. If it doesn't bounce off 50, it bounces off 100 or 200. All right? So it's bouncing off moving averages. So you might see it's bouncing off a moving average, but at the same time, it's bouncing off a support level. This was initially resistance. The market is bouncing from that level, exact same level. Was support, that's a zone. Support zone, resistance zone. Market comes back, look at how it bounces off that 50 EMA, between 50 and 100. Look at how it bounces off between 50 and 100, okay? So it could be bouncing off resistance, but at the same time, that's a moving average. That's an additional confluence. You may also see a chart pattern. You may see a chart pattern forming, okay? Now, remember, we talked about things like head and shoulders, double top, double bottom. So you may see a signal forming, but when you look at a chart, I say, oh, wait a minute. Is this not a pattern? For example, here, you see, you might be having a resistance here from the past, resistance. And you see a candle breaking above this. But you remember, oh, was this not a double bottom? This bottom 1, bottom 2, slanted. They don't have to be straight W's. This is a slanting W. The breakout happened here. This is where you should have entered your trade. So you imagine entering a trade here, you'll be too late. And by the time you're entering a trade here, we are in a downtrend. So you're trying to buy in a downtrend, which is wrong. Here, you would have a better signal perhaps here. So you would consider we have a downtrend line, we have a moving average, we have support and resistance, and many things are coming together to tell you you can buy, you can sell, you can buy, you can sell. So those are the confluences I expect to see. So at minimum, trend, support and resistance, and candlestick patterns. But when you get a signal forming where there is a Fibonacci, where there is a trend line, where there is a moving average, where there is a Bollinger Band, where there are indicators, where there is divergence. You remember divergence?
Yeah.
Let's say, for example.
I'm not seeing what you're doing. Hello?
You are not seeing?
I'm not seeing what you're doing. I think the chat is hanging.
Oh, sorry.
Yeah.
You're able to see now?
Yeah.
All right. So this is a downtrend. We all see this a downtrend. So I want to take some setups. I have my support, which is now going to act as resistance. Market's coming to resistance. I also have support here, acting as resistance later. I have support here, acting as resistance later. So those are good levels. I have some resistance from the past, acting as resistance here. Now, I want to take trades here in a downtrend. So already I know I have a downtrend, I have my resistances, and I can read candlestick patterns. Those are the three minimum things you must have to enter trade. And we already have two of them. The next thing we just need is to read candlestick patterns. So I come, market starts a downtrend here, comes back to resistance, gives me a bearish engulfing. Can you see that?
Yeah.
Bearish engulfing says sell.
Okay.
But I want to see which other thing can I use before I enter this trade. I know I have a bearish engulfing here. I am at resistance in a downtrend. It's a good signal. But can I get more confidence in this trade? And I realize, well, what else can I check? I pull my Fibonacci. I put it at the top, push it to the bottom here, and see where that bearish engulfing occurred. Where? Between 50 and 61. That is good. That's an additional confluence for me. So I think I'll be able to take this trade. But maybe I also want to see what is happening with the volume. Pull my volume. And I want to see here. Bearish engulfing, volume has increased. Green candle, small volume. Red candle, high volume. That might also give me an advantage. So I kick out volume. I know, okay, that's a nice one. I pull out an indicator like RSI, the one we were using for divergence. You remember?
Yeah.
We use this for divergence. And I want to see whether there's divergence. I know market was here on this level, on this candle. Market's on the same level on this candle. While this is flat, this one is going up. That's divergence. So I can see divergence, which is another signal. So that's how you start checking with Confluence. You look at many other different factors that could say, yeah. And I can draw a trend line. My trend line looks like that. My trend line says it's a downtrend. Market's moving down. All right, we come to the second signal. The second signal obeys the rules. We are at resistance. We have a downtrend, and we have this is like a dark cloud cover. Or I can combine this with this to make a 3-bar reversal pattern. 1, 2, 3, which says we can move down. And at that level, I also want to see whether we have other confluences. The confluence we have here now is a clear downtrend line. You remember you need 2 points to draw down a trend line, point 1, point 2. Then you draw it, you extend your line. So this signal is forming right on a trend line, right on resistance, right on moving averages, and I suspect on a Fibonacci as well. See? Right on 61.8. So that's what we are calling confluence trading. There's nothing so technical about it. That's what we call confluence trading. You look for other reasons to justify your trade. And I think that brings us to the end of today's class.
Confluence trading covers all what we have covered now.
Sorry?
Confluence trading.
Yes.
It covers all what we have covered.
In confluence trading, you put every knowledge you have about the markets on a signal. Yes, everything. Everything. But remember, the minimum 3. You must have a trend, you must have support and resistance, and you must have a candlestick pattern. Those 3. If you have those 3 and there is nothing else, you can enter a trade. However, if you have those 3 and you can add a trend line and see it's working well, you can add a Fibonacci and see it's also aligning well, that's a better signal. Yes.
You become more confident.
Yeah, it gives you more confidence. It's like you can look at it from a probability perspective. You can say, if for example, you can say this. You can look at it from this perspective. You can say, if a trend gives you 20% confidence, your support and resistance is a trend. Support and resistance also gives you 20% score. So now you have 40%. When you add a candlestick pattern, candlestick signals, they give you an additional 20% probability. So it means with these signals, you have 60% probability of winning a trade. Now, when you add Fibonacci, it gives you another 20%. Now you see we are talking about 80% probability of winning. When you add a trend line, another 20%. So you see this like 100% now. Yes. So they make things work. Why is confluence important? Because there are people who trade with support and resistance only, they don't use trend lines. There are people who use trend lines and they don't use support and resistance. There are people who use Fibonacci alone. They don't draw these things. There are people who use moving averages only. They don't use any of these. So when you combine them, you try to have everybody's mind in your signal. If someone was using a trend line, you're also using the trend line. If someone was reading a candlestick pattern, you also read a candlestick pattern. If someone was trading a bounce from a moving average, that's where you took your signal. If someone was following a trend, you're also following a trend. So you go with those following the trend, with those following candlestick patterns, with those following support and resistance, with those following trend lines, with those following Fibonacci, with those using volume. So you are everybody in the market.
Yeah.
Which is better. Because sometimes candlestick signals alone will fail. Sometimes support and resistance alone will fail. Sometimes following the trend, you are entering at a wrong place. Sometimes following a trend line could be wrong. But when you put all of those together, you get a very sure signal. That's what we call sure shots. Sure shots. Nothing is 100%, but when you trade like that, those are clear signals that even if they lose, you say, I did the best job I could. You can see this is a clear downtrend. You connect at this point, you connect at this point. Now you're waiting for market to come back to the same point. Comes back to the same point, you read evening star. But you remember this is an evening star. Why is it forming? Moving average, 100 and 50. These are dynamic support and resistance. When you check in the past, we were at a resistance. Some level of confidence. If you pull your Fibonacci and drag it from here and drop it here, pull back, this will be around 61. I know, I don't want to say it could be around. Let's do it. This is what I told you. This signal is happening around 61.
Yeah.
So that also gives you another additional, benefit. So that's how you trade. So it is not always that these things would happen, but when they happen like this, you have a better signal. So I'm not saying you must have all of these things in every trade. Like I said, there are 3 things you must always have: trend, support and resistance, and your candlestick patterns. The rest of the things can be added if they are available. If they're not there, just leave the market. Just leave the market. Now, remember also, there are people who trade charts, chart patterns only. There are people who are looking for chart patterns only. They don't care. They just look for a W like this, which is a double bottom. They draw the neckline, market breaks above the neckline, they buy. They keep moving. They are waiting for another signal. They're just looking for those patterns only. They look at where, for example, let me see another pattern for you. There are many, but when you start scanning the chart, sometimes you don't see. There's another W here. Clearly, you can see that. Market went up. Market came down. Market went back up. Market came down. Market broke the neck with this candle. People sell. There are people who trade like that. So Forex has a lot of trading styles. There's a lot of trading styles. Clearly, there's a range here. It's a ranging market. I said when you see candles operating between moving averages, this is a ranging market. When you see markets moving up, one candle down, two candles up, this is a range. It's horizontal. You wait for a breakout. There's a breakout here. This candle is a breakout. So how do I know the breakout is genuine? Let me see what volume says. Before the breakout, what did you see? Volume was increasing. The breakout is genuine, you can buy. So there are many ways of trading the market for sure. You just need to identify a few strategies and start off, and then you start adding strategy after strategy as you progress in your skills. Any questions for today?
Okay. The only hard thing that I'm getting.
Yes.
You can hear me?
I can hear you, yes. Hello? I can hear you.
The only hard thing that I'm getting, although I think I'll be able to concur.
Yes.
Is the candlestick signals.
Candlestick signals?
Yeah.
Or you're not very sure about them?
Yeah, but I think I need to, I don't know whether it is to climb or it is what I need to do.
I gave you the video. You know, when we did that session, I gave you the video on.
Yeah, you did.
That was video number 2. So go and watch it.
Yeah.
Go and watch it. Look at those candlestick signals in the ebook I shared with you, the 9 or 10 candlesticks, reversal candlestick patterns. Yeah. They are very important. Why?
Yeah.
Tomorrow, when we talk about strategies, because we are now going into strategies, when we start talking about strategies, strategy number 1 is engulfing strategy. So you need to familiarize yourself with engulfing candlestick patterns. Bullish engulfing, bearish engulfing. Strategy number 2 will be inside bar strategy. It's based on inside bar candlestick pattern. Strategy number 3 would be pin bar strategy. It's based on the hammer candlestick and the shooting star. All right? So you better go back and familiarize yourself with those candlestick patterns, because that's what we talk about tomorrow.
Yeah.
All right. See you tomorrow then, God willing.
Thank you so much.